Aloha loves, welcome. My name is Digmera and I am your host. I believe it is every woman's birthright to have financial independence and freedom. I am a self-made multimillionaire. Now I work with others to do the same. Let's get started. Aloha, beautiful souls. Welcome. Welcome to another episode. Today, what I want to do is I want to talk about dividends and I want to break it down. I want to explain what a dividend is and the different components of a dividend, and also talk about how you can leverage tax-free savings accounts and tax shelters to allow your dividends to grow tax-free. Okay, so let's get into it. Let's get started. So what is a dividend? A dividend is, the definition of a dividend is a payment made by a company to its shareholders. Essentially, it's a way for a company to share profits with its shareholders. Okay, so a dividend is tied to an investment that you hold, and that investment can be a stock that you hold, it can be a mutual fund, it can be an index fund, and some of these different, the investments, the mutual funds, the index funds, some of them have dividends and some of them don't. And how do you know if the investment that you purchased has a dividend? It'll say it right within the portal, right? So when you log in and you look at your investment, it'll say whether it has a dividend or not. You look for the dividend section, and if it has one, it'll specify the details, that it'll list the specifics of it. And if it doesn't, those sections will just be blank. Okay. So, and now dividends, you can have cash dividends, which is the most common type of dividend, or you can also have a stock dividend. So a cash dividend, the company will pay you out in cash directly to your account, and a stock dividend, you'll be paid in additional shares. But as I said, the most common one is the cash dividends paid out directly into your account, and it'll literally appear in your account as cash. Okay. So one of the things that you need to look for is you need to look at the dividend payment date. Okay. And the dividend payment date is the date that the company will pay you the dividend. It'll pay out the dividend. And the most common timeline is dividends are paid quarterly, so they're paid every 3 months. Okay. Now, what is an ex-dividend date? You might see that on the account as well. An ex-dividend date is the date by which you need to have purchased the stock in order to be paid on the dividend payment date, right? So there's an ex-dividend date and you need to have bought the stock before that date. And if you didn't, then it'll just, on the next payout schedule, you will receive it, but you'll just miss it for that quarter. Okay. And then as I said, I think the payment date's the date that you will be paid. And the other piece is like, how do you actually like calculate and determine, like, what is the formula? How do you actually determine the dividend price, like the dividend share, and the yield? So it'll specify, like it'll say, for example, typically on my accounts, what I see is I'll see like quarterly dividend, and it'll say like $1.05. And then the yield will be like 4.22%. Okay, so let's use that example, right? So the stock that I'm talking about, it's the price per share is $99.46 right now. And obviously that price fluctuates. And then the quarterly dividend price is $1.05. And the yield is 4.22%. Okay, so what that means is on that stock, I earn $1.05 per share. And of that stock, I'm currently holding 1,700 shares. So that means every quarter, every 3 months, that stock pays me out 1,700 times 105. Okay. And as a total, the yield, because the yield is 4.22, that means that stock is paying me out 4.22% of that stock every single quarter, which is, I mean, every single year. And that's on top of that stock constantly going up in price. Okay. So now, as I said, so what happens with these dividends is they're paid out, that money just appears as cash in your account. And because the account that I'm holding that stock in is actually a retirement account and it's a tax sheltered retirement account, it means that any of the dividend that's paid out in cash, it's actually not taxable at the time that it's paid out. It'll be taxable later when I withdraw the funds. But essentially, I can take that dividend and just reinvest it and it's all tax free and it continues to grow tax free. And a lot of my clients, when I explain that to them, they're really surprised. Like, because when you think about it, that's quite a bit of money. Let me just look it up because I have my account open. Um, I'm just loading it up. Okay, so every 3 months, that one stock pays out approximately $1,785. Okay, do the math. Times four, that means that one stock is paying me out $7,140 per year that I get to reinvest tax free. And that continues, I add that and it just continues to grow. And when that money is paid out as a dividend, you don't have to reinvest it in that same stock. You can take that and you can invest it in any other type of investment that you want to. So there you have it. Short and sweet. Dividends are really powerful. And you get to choose whether you have them in a tax sheltered account or in a regular investment account. And in the tax sheltered account, is it pre or post taxed income that you're using to invest? Hope you found this helpful. Wishing you a wonderful day. Much aloha.